you ever hear the tragedy of
Tesla? Tesla has been plummeting since the beginning of the year. So is it a great time right now to buy this company or only the beginning of a massive downfall? This is gonna be the question that I'll be answering in this video, where I'll make a full stock analysis followed by a price prediction of Elon Musk company's Tesla. But before we understand where the company is heading towards for the future, we must understand what has been causing this massive downtrend lately. In fact, there are multiple factors that have caused this EV giant to lose over 30% of their total value since the beginning of 2024. First, the high competition in the electric vehicle market with the coming of important competitors in Rivian and their Chinese competitor BYD has actually created more offer to the global population for the ones that are looking for electric vehicles, which has caused a price war. Indeed, with the current macroeconomic conditions where we know that the interest rates are through the roof and where we know that the price of goods have been skyrocketing lately, this has caused a negative trend when it comes to the consumer behavior, where in a recent study, 92% of Americans respondents have been saying that they were aggressively cutting their spendings in response to the high inflation. This has created a lot of pressure on a company like Tesla that was for a long period of time considered as the only viable option for the ones looking for great electric vehicles. And the results of it came at the end of 2023 and at the beginning of 2024, where we've seen that Tesla has announced many different cut prices for their different cars. One of the reasons behind it was the statement that they've been saying that the growth that we should see in 2024 should be significantly lower compared to the growth of 2023. And so the objective behind this decision was obviously to make their cars more affordable for the global population to be able to try to increase their global sales. The problem with this scenario is that it hasn't only put some pressure in terms of their revenue and their market shares, but also in terms of their profit margin. A few quarters ago, one of the main highlights of Tesla was its robust margins, where we've seen that their EBITDA in 2022 has reached about 23.52%, but we've seen that in 2023, because of all the problems that they've been facing, this number has been shrinking to about 17.19%. And so when you combine this problem with some important bad news that they've had recently, notably some suspect arson attack that shuts down electricity supplies, the least we can say is that Tesla doesn't currently have some great momentum behind them. This has made that many analysts have been downgrading Tesla rating over the past couple of weeks. Lately, we've notably seen that Wells Fargo has ironically said that Tesla is a growth company but with no growth. However, one crucial point that is often omitted by many investors is that Tesla isn't a simple electric vehicle company, but it has many different competitive advantages. Indeed, one of the important characteristics of this multinational is that Tesla is at the forefront in terms of the autonomous mobility movement, notably with the potential of some full self-driving as well as their great autopilot features. This means that in the near future, Tesla technology could make the car drive for itself. Add to this, Tesla currently has the most valuable assets desired by all the different electric vehicle companies, which is the battery. Thanks to their innovations in the long range and the high performance of their battery technology, their automobiles are getting exceptional gas mileage and they are leading their competition far behind them. And you cannot hide that this is one of the most important aspects for all the potential customers that are looking for a new electric vehicle. Because in fact, even if you have the coolest car, if it isn't able to have the autonomy to reach a certain destination and that the other competition car is able to reach it, it obviously makes that the competition car will be the most attractive for the potential buyers. Another aspect of Tesla greatness is also coming from the efficiency of their total production. Indeed, since their manufacturing includes every single step of the process, from making batteries and solar panels to assembling the different cars, it makes them gain a lot of time while controlling the quality of their products. Also, over the past couple of years, by being being able to connect all the different gigafactories all around the globe, Tesla has solidified its capacity to scale production and fulfill increasing demand, which can be proven in their more recent earnings report, where we can see that the production and deliveries of their new cars have been booming over the past couple of quarters. It is also important to note that Tesla, as I told you earlier, isn't only producing electric vehicles but also different solar panels, as well as great storage units, for example, their famous Powerwall. And finally, another crucial point to understand about Tesla is that it is considered as a highly advanced technology company in opposition to the classical cars that tend to degrade through time with their out-of-data software. Tesla cars tend to do the complete opposite by consistently adding new features, fixing the different problems remotely, and the improvement of the performance of their technology are all part of their over-the-air updates. It means that by buying a Tesla car, it is pretty much the same as if you were buying a time machine with some new updates that could come at any time. And so it makes that even if the company has faced some quite important difficulties in their more recent earnings report, it still has some great edge against their overall competition. However, according to TipShrink, we can see that the analysts are pretty mixed about what will be the future of Tesla, where we can see that 10 of them would be buying, 19 would be holding, and 6 would be selling their Tesla shares. But for the next 12 months, we can see that the consensus is that the price target of Tesla would be of about $207 per share, or an upside potential of about 27% compared to their current price. So according to this information, the company would currently be an interesting bargain. But now let's see what the valuation measures are telling us about the true intrinsic value of this company. At the moment, we can see that Tesla currently worth over $559 billion, but with some pretty high price to earnings, price to sales, and price to book ratios, which would be indicating to the investors that this company wouldn't be that undervalued according to these factors. As I told you earlier, in terms of their profitability, we've seen that with the price cut, they have been quite importantly dropping in terms of their profit and their operating margin over the last 12 months. Nevertheless, we can still see that they've been able to achieve some great return on equity during that same period of over 27%. During that same year, we've also seen that Tesla has generated close to $100 billion of revenue, with some slight growth in their latest quarterly revenue growth of about 3.50%, but more importantly, some incredible quarterly earnings growth during the last quarter of over 100%. Then an excellent news for the investors looking to invest in this company is the fact that they are not depending on the debt that they have of less than $10 billion, especially when we know that they have over $29 billion of cash and that they have a debt to equity ratio of only 15%. However, as always, to evaluate what is the volatility of the company, we'll be using the beta on a 5 years period, and with a beta of more than 2, it means that the company will tend to fluctuate over 2 times more than the overall market. Nevertheless, over the last 52 weeks, we can see that it has lost about 8% compared to the S&P 500 that has gained over 30% of value. Now, to determine what is the true intrinsic value of this company, as always, I'll be using different valuation models to help me with this task. Starting out with the Peter Lynch valuation model, where you simply add the future growth of the earnings per share with the dividend yield and that you divide with the price to earnings ratio. And so despite some incredible estimate for their future earnings per share growth for the next couple of years, we can see that the company is still not giving any dividend and it doesn't have a great price to earnings ratio at the moment. So this is showing that the company, according to these factors, would be overvalued right now. As I just told you, since the company isn't giving any kind of dividend at the moment, it means that we won't be able to use our second model, which is the dividend discounted model. But for our third model, which is the discounted cash flow model, as always, we will be discounting the future free cash flow of the company that are predicted with our discounted rate or our weighted average cost of capital that is found by calculating what is the cost of debt, the cost of equity, and the cost of debt and equity, which is giving us our WACC. And so with these indicators, years, we can find that the company intrinsic value would be of over $200 per share, or an upside potential of over 20% compared to their current price. And finally, with the two last models, which are the Graham's original value formula and the Graham's revised value formula, in both cases we find some different intrinsic value, where with the original value formula we find that the company would currently be an important buy with an upside potential of over 55%, but with the revised model we can find that the intrinsic value would be quite lower, meaning that it would be currently a sell or an overvalued company. As you've been able to see in this video, despite being in a quite bad momentum lately that was caused by many different factors, Tesla is still a company at the forefront of their market, where we've seen that they've been able to grow consistently over the past couple of years, and where it is predicted by many people that they should continue to be an important actor in their fields over the next couple of decades. So personally, it is definitely a company that I will keep in my portfolio and on my watch list for the next couple of years. But on your side, if you're looking for another interesting company that is, however, offering some important dividend income to their shareholders every single quarter, well, check out the video that's gonna be right over here, and I will see you soon. Peace!